like to continue now with ARRIS International. And what we're going to do today is we did the first project based on that, and we're going to continue to show you how do you take the things we've talked about and apply it to a real company using real-time data, current data. And hopefully you have learned from Project 1 that the 10K has a lot of information. And the reason we use 10K as opposed to Yahoo Finance or something like that is that we can actually see it in detail, and it's not been summarized into a standard format. It gives us a lot more information. And just as a quick review, the key things we have in here, when we look at the table of contents, it talks about the business in item 1, tells us about the business. Then it's going to tell us what are the risk factors. But then when it gets into, it's going to give us a selected consolidated historical financial data. This isn't the detailed financial statements. They're down here in the consolidated financial statements and supplemental data. So we have the summary. Then we have right here, management's discussion of analysis of condition and risks. This gives us a lot of information in addition to the investor presentations that you looked at. Then we get into the consolidated statement of supplemental data. The rest is all good stuff, but these are the key things. So we want to always be based on that. Now, in Project 1, you took the company, you looked at its strategy, its products, its customers, and what is it about. We then took data that we extracted from the 10K, put it in our worksheet, and started to do some analytics around it. We were looking at the cash flow. How does cash move in and out of the company? So what we're going to do in continuing in that, we are going to go over to the worksheet that I did. And the first thing on Project 2 is to create a table, and this is a table. So what we have is, we have the data, which everybody brought over. And if you look, we brought it over for a couple of periods. So we have it in an Excel format, and we're now starting to work with the data. We looked at the sales profit, the cash flow, the cash conversion cycle. So we're understanding how cash moves through the company. So the first assignment in Project 2 is to create a table, and a table showing the financial results. So we always start from right to left, with this being 2012 through 2016. And the reason we do it in this direction instead of the other way is more that when you start doing trends, you're going to move from the oldest to the newest. And if we were in Finance 315, which hopefully some of you might be interested in taking, we actually take this information and then we're going to forecast out to the future. So basically, though, it's looking at it and saying, what can we do to do a summary to understand what's important to the business? Because all of the detail that you have in the 10K is good, but when we're looking at it to understand the company and do some basic financial analysis around it, we need to summarize it. So what I did here is I took a look at the 10K and the various pieces of information, and I said, what's important to this company? So what I did is I set up my 5 years. Here's my columns. And I said I started with net sales and cost of sales, gross margin, but they didn't have a percent. So I put the percent in because to me, the margin becomes something important to really look at, so that when we're looking at this, it was 34, then it dropped, and it continues to drop. So that means the cost of producing the additional product is not getting better. So what I did is I selected net sales, cost of sales, gross margin. I calculated this, so I built in a calculation there. Okay, so when I'm building this, I'm always trying to use formulas so that I can copy and paste as I'm going. Notice that I labeled each column, that it's year-end 12/31. Not all of your companies have a calendar fiscal year. their fiscal year. So they may run February 1st to January 31st, September 1st to August 31st. It varies. So then I went through all of the different expenses and said, what's meaningful? And what I found is, obviously, selling administrative is big, but they spent a lot of money on research and development, amortization of intangibles, integration, interest expense, foreign currency gain loss, loss on investments, and then all other, and I netted it all out to come up to income before taxes, net income, and they have something called minority interest, and that gives us the income to the common shareholders. So these are the actual dollars, but what I did is I selected the information that I wanted to see. What is going to give me a picture of the company? And I felt that this gave me a picture. So when you're doing it, what I want you to do is, yes, I need you to do 5, but notice that I'm using commas. I don't have the decimals out there. I've underlined whenever there's a total or a subtotal, it's underlined. It's important because then we can see how it flows. So I picked selling administrative, R&D, and then they had these things in here. Now, right now, I don't know what they are. I know what amortization of intangibles are, but I'm not sure why that's such a big number. Integration and restructuring. Well, why are you always restructuring? What's going on with the company? So what we have here is this is highlighting some of the key things we want to understand about the business. And it comes down to income before tax, taxes, net income. So what I did is I created a very small chart here, and that has all 5 years together. So what I've done is I've taken information and I've put it together. Okay, so you have to, when you're doing this, the first thing you want to do is obviously make sure you lay out your 5 years. You got all the data over here, and data from the 10K. All of that just comes over to there. It's all referenced. If you look up here in the cell, I've referenced it from there. So I'm bringing it forward. All the numbers move forward. So that's the first thing I did. So you need to do that. You need to select which ones are meaningful, what's not meaningful, okay, and put some things together. The next thing I talked about in the video about understanding a company is doing common size, because as you can see, these numbers have changed. They've grown, they're spending more money, but by common sizing them, what I did is everything is based off net sales of 100%. And then I calculated what these were as a percentage of sales. So we know sales are 100%, cost of sales was 75. And if you look at the formula, what I did is I divided 5 million by 68, and that gave me 75. Difference is my gross margin. But then it shows me what percentage of selling and administrative expenses. And as we can see, that's declined. Same thing when we look at R&D, that's declined. But when we look at the amortization of intangibles and integration and restructuring, look at the size of that number. It's increasing. So it helps us evaluate the relative importance and the change. Okay? And as you can see, when we look at it like this, we get a different picture than this, because this is all in numbers, but when we put it into this common size, we can compare each year, but we could also now compare that to a competitive company to see how they perform. Next thing, so that's the common size. Next thing you want to do is, what can we show graphically? And if I tried to take all of this information and put it in a graph, it wouldn't necessarily tell me anything. So what I did is I did it a little further. I'm trying to give you a picture. So sometimes a picture can speak 1,000 words. Okay? So what I did is I said, what are the key things I want to look at graphically to see what they can depict? And I picked these. And as you can see, I just created a label. Notice it's labeled. So this is ARRIS International. This is by year. So we can see, again, here's the sales, the blue, and then we can see how much is the cost of goods sold, and we can see the relative relationships there. So that's one form of a chart. You could do many. It's what's going to be meaningful. In this place, I did a similar chart, but I only had two variables, net sales and income before taxes. So what I did, and this gives us a picture that sales have grown, okay, substantially, and if we ran a trend line there, we'd find it straight, but look at what happened with net income. It's essentially flat. So whilst the picture that you're seeing of the financial results is sales are growing, profit isn't going too far, too fast. Because you would expect that if income was going up, that if sales are going up, that there'd be a direct relationship to higher income. And we're not seeing that. So sometimes that chart shows you that much better than you could here. You can eyeball this, but right here is where you see it coming down, that it's more meaningful. So that's our that first assignment. That's worth 5. Next thing to move into is the sales analysis. Now, as you notice, I just brought this piece forward. So if you look right there, let's color it up for you. Okay. This I simply brought forward from what you did before, right here. So I simply brought this over, but now what I want to do is I want to understand why did it grow. So I laid it out just a little bit different, and what you have here, it changed by $2 million. Okay, that's really in billion. So why did it change? We could say, oh, sales went up, this happened, or that happened, but we want to be understanding the company to see how it ties with the strategy. So what I did as I was doing that is I had to go through the 10K. And I found a number of things, and what I want to reconcile is I want to explain what changed, okay, in more detail. So what I did is on page 10K, in the 10K, page 40, it said the primary increase in sales was a result of the Pace acquisition in January 2016. So that's a clue to me that they bought a company, and that is an increase. So I went through the 10K. Did they tell me anywhere of the $2 million increase how it was associated with Pace? And I looked, and I couldn't find anything. But I found a number of other things. First thing I saw was they report sales by business segment. They have this CPE, which is customer premises segment, and that's what's on a customer's desk in their facilities. And then there's network and cloud. Customer premise segment, that includes our routers and things like that. NNC, network and cloud. So they broke the $6 million down further into these 3 categories and other. And why under is negative, I don't know. But it's a small number. But what I'm seeing is I've now taken the $6.8 million and I've broken it into smaller pieces. So what I really see is the biggest change is in customer premises segment. If I keep going, I can go back and look previously. So now I can see this, and they explained it primarily by this change here, these 3 numbers, by the acquisition and other customer expansion into video and broadband. So what I now have done, I've taken this $6.8 million, I've broken it down further into these 3 categories. Okay, so I have a better understanding of what was driving that, which of their strategies is working. Now, you're going to have, everybody has a little different business, so the question is, what is your business? Okay, is it a volume thing? They sold more of something? This is where you got to go through the 10K. You take a lot of reading. But then I found another piece that said, okay, geographic. They said, well, of their sales, $6.8 million. So you notice it all ties together, as well as the variance, that the increase was primarily in the U.S. U.S. sales went up 44. International went up 39. So we can see what happened here. Okay, and we do know from 2015 when they're talking about this that CPE was lower from lower video product sales, and NNC, network and cloud, had the addition of a new company called Active Video in 2015. So that's what drove this number, okay? And this went down because they had lower video sales. So we could look at it geographically. Next thing I found out as I was digging is I found out that they have 3 large customers, AT&T, Charter, and Comcast. So they broke down the sales to these big customers, and look at over half the sales are to 3 companies. That possesses risk for the company, but I could clearly see that that AT&T went up 160%, 553, Charter 100, and Comcast 630. So I could see that of that increase, we have roughly 2/3 is from 3 customers. So that gave me some more information. So what I have, as I've laid this out, is I'm getting different ways of looking at it. Not just one. I'm not really sure. What I would ideally like to do is be able to figure in pace. Okay? But the last thing I found, and I kept digging, I didn't stop. One of the things you've got to be cautious of when we're looking at 10Ks is there's a lot of information. Okay? So I found a detail business segment. Okay? And in that, everything is broken down on a much more detailed basis. So for me, this is what becomes important because I can now understand it where it is, and then that the acquisition is there, but we can see which ones really grew, and we could see that's really in the video. And when we look at their strategies, we can see that this is an important strategy. So this is an example of the sales forecast. We want to get a level of detail that's meaningful. Okay? So take a look. The key on this is we just don't want to have this in a broad sentence. We want to be able to break that down. And every one of your companies has the ability to do that. I then moved into the ratios, where I did the ratios, and you can go through this, but it's straightforward. My current ratio, inventory turnover, solvency, debt to equity, tangible. I'm generating information at this point, data for me to look at. Yes, I know what the current ratio is. I know what the academic meaning is, but what is this trend telling me? What's this trend of inventory turnover telling me? Well, if I'm just looking at this, it means I'm turning my inventory more. That's a good thing. The faster the cycle can run, because this comes back to your cash conversion cycle, you need less cash to operate. We can see that over the time, when we look at the debt to equity, we can see over the past 4 years that the leverage ratio has come down. They were much more leveraged back in 2013, and now they've dropped. So we're looking at a trend here to see what's meaningful. Red flag, okay? So let me just, let's use that color. What we're seeing is right here, see that? Yeah, it's not really easy. But what we're seeing is that they don't, even though they have a nice equity position, they're not leveraged. They have a lot of intangibles and goodwill. So they have negative equity. That's why we look at that, so that we can better understand it. And that's telling us that the value in this company from a balance sheet perspective is a function of those intangible assets, which we assume have value. But right now, we're calculating stuff so that we can analyze. We can see that they can repay debt. That becomes pretty easy. And the debt coverage ratio, very strong. Now, I want to just drop down for a second here to the return on assets and return on common equity. You want to base it based on the average assets for the year, right here, and the average common equity. Because remember, the balance sheet is a point in time. Some companies will actually show you what the average assets for the year are and the average common equity. If your 10K shows you what the average is, you can use that. Now, not all companies do that. So what I did, because I didn't have that, is I took the beginning and ending balance and I divided it by 2. So I assumed there was an average. Okay? And then I calculated net income divided by the average assets gave me the return on assets. And what you can see is they're all over the board. But notice what I did is that the numbers all tied back. Just look at that. It was 45, 23, 5, 16. That was the beginning of the year, which is equal to the end of the year. Okay? And you can see it works its way all the way through, and I'm calculating that. Okay? So we have that same thing on average common equity. I had to calculate it out by taking a simple average. And again, we can see it's all over the point. There's really nothing. We gotta. This is telling us there's a lot of stuff going on that we need to understand. So the first thing is we're gathering data, we're computing it. So what the purpose of really having you do this, one is to build some Excel skills up so that and formatting skills, which becomes very important, but also for us to really look at, to be able to ask questions to understand what this means. So what I did is I came up with a set of questions, and the 10 questions for me, and that was based on, I went back and looked, what are the intangibles? Why is the amortization so high? So I'm coming up here, and what I'm seeing by this is, look at how the intangibles have grown that amortization. That's a big, big number. Okay? They amortize $397, but when I get into my ratio analysis and I'm looking at this, they got a lot of, if we're just looking at this 3690, this intangibles, I got to understand what that is. That's a big number. Okay? And it's really when I'm looking, I want to look at the relationship between this and the 397 there. That becomes an important thing for me to understand, because when I look down here on my graph, it is a big piece of the profit. Now, if they didn't have this amortization of intangibles, look at what would have happened to the pricing or to the profit. Okay? It would be a lot bigger. So I need to understand that. So that's the first question I really have. Next is related to that, what are the restructuring and integration costs? Okay, we see that again right up here. They're spending a lot of money to integrate and restructure businesses that they bought. Okay, but is that going to go away? But what is happening? Are they getting scale? What's happening? Then I ask myself, should we look at the performance of the company excluding those costs? That once the costs are done, that they won't be reoccurring? So should I look at the base business without these special things? I also took a look at the, I'm looking at the interest expense, $79 million. Okay, but now when I went over to the ratio, I'm looking at the debt. Okay, there's my total long-term debt. It's $2 billion. That seems fairly high. So I'd want to do those. How has the company been paying for their acquisitions? I know they made them, but when I look at the debt in my ratio, it did go up, but it doesn't seem to be going up by much. In fact, I'm actually using less leverage. So that means I must have done a stock offering, and I'm funding some of this acquisitions. That's a question I have. Next, why are the sales so volatile? And I come back here, and I could see that it's up, down, it's all over. This year it's up 42, this year it's down 10, and these segments are going back and forth. So my question is, why is it so volatile? Is it acquisitions? What is it? Is it a product that you sell, and once you buy it, you don't need another one? Next is, why do they have so many investment losses? Again, I'm focusing on the income statement, and this sort of hits me like, if you have investments, why are you losing so much money? They're a manufacturer. They do technology. Why are they making money or losing money on investments? That's a question I have. Is there a way to break out the acquisition by business segment in 2016? I didn't see it, but that's a question that I have. But then I go back to this leverage ratio. Why is it declining? Okay. We're seeing the leverage go down. We're seeing the debt to income go down, but yet we're seeing tangible net equity getting worse. It had been really bad, got a little better, and then it went down. But when we're looking at this, the EBITDA, and when we look at the times interest earned, we're really seeing that this is a big, there's a lot of coverage here. And the cash flow, when we looked over here, okay, we realized that operations is still providing a lot of cash, okay? And that becomes important when we're looking at a company. So those are the questions. So what you need to do is take your worksheet, add these in, do first your summary in dollars, then your common size, and then what do you need to do graphically to display this? So at this point, I just want you to do it in Excel. We are going to move this information into PowerPoint for the final presentation. So that's what I have. If you have any questions, let me know. And remember, it all goes back to the 10K. As I was going here, I didn't start, I don't want you to stop here and say, oh, sales went up $2 million or 42% because of the acquisition. Okay, that's not helping us understand. This is helping us, and I kept digging down because I wasn't really happy about what I was finding. So now the question is, and this is something I'm going to do some work on, because one, I happen to have an ownership position in the company, I own the stock in this company, is, well, how can I combine these three things? Is there a way? So I'm going to do some additional research, just as I'm going to encourage you guys to do, to say, how can I combine these? How can I combine them? I don't know. Maybe I'll find something, maybe I won't. But I know there's something missing from each one of these, so I'll go figure it out. So if you have any questions, let me know, and have a wonderful week.